That said, let's turn our attention to the star of yesterday, the IT sector. That was the big outperformer. Now, JM Financial believes that demand may not bounce back rapidly. Tariffs and Fed rate cuts could be the trigger for a mean reversion of the multiples. We're now joined by Abhishek Kumar, the IT services research analyst at JM Financial, who joins us on the show. Hi, morning, Abhishek. Good to see you. And as always, what do you think? The reason for the bounce, the tech index has suddenly shown some signs of actually outperforming. Just in the last few sessions, it's falling less on bad days, and on good days, sometimes it does better. So what do you think? Are we bracing for a bit of a bottom formation and things start moving up from here on?
Yeah, hi, good morning. Thanks for having me here. You're right. I think investors were looking for where the bottom is, given the consistent flow of negative news. But what we have seen, first on just fundamentals, the 6 global companies who give guidance, which we track closely, Infosys, HCL, Capgemini, Cognizant, etc., all of them raised the lower end of their guidance in this quarter. So that's a very strong evidence that the worst that some of these companies were probably fearing did not play out, nor do they expect it to play out in this year. So that's a good sign. And then if we juxtapose this with where the valuations are, if we look at the top 5 large cap IT companies blended PE, they are now trading at a discount to both Nifty as well as S&P 500, which hasn't happened, in last 5 years. So put together, looks like, the growth rates, etc., have bottomed. Valuations are very reasonable. And with rupee depreciation, there will be some support to the earnings. Okay. So, all these make up for a good, for a bounce back, a potential bounce back in the sector.
The tech index in comparison to the Nifty, what is that number right now? As you're saying, that has narrowed down completely. In the past, we have seen it go, that premium go up to 30-40% as well, I recall, at peak levels. So what was it at peak? What is the median? What is it now?
So I don't have the numbers on top of my mind, but if we just look at the premium of the top 5 IT services PE versus S&P 500, it is 1 standard deviation below its mean, and it's actually at a discount. Same is the case when we compare large cap IT services PE with Nifty. It is below 1 standard deviation over the past 5-year mean, and now at a discount, 7% discount to even Nifty PE. So these are levels we have not seen, at least in last 5 years.
Abhishek, hi. Good to have you on the show this morning. So I was taking a look at your calls, and you do like several of the mid-cap IT names, more mid-cap IT than large-cap IT, and that's the only thesis that's really worked, right? Names like Persistent, Coforge, and I think these make it to your buy list as well. But even for a lot of the mid-cap names, Q1, the growth rate slowed down. Yeah, we've got your whole list up on the screen. Mphasis, Persistent, Coforge, Hexaware. For a lot of these mid-cap players as well, the growth rate slowed down. Coforge, itself. And of course, there was this whole issue about whether they're investing in data centers and whether that's, that's not entirely related to the base business. You think the thesis for mid-cap IT will remain as strong? Or have valuations now made the asking rate even more demanding, and therefore it could be a challenge to meet those expectations?
Yeah, so, I think the growth rates for mid-cap will continue to outpace, the larger peers. Coforge has a very strong momentum. Persistent is doing consistently well. At this stage, we prefer, Mphasis and Coforge, while we have buy on Persistent also. But I think we would rather prefer players where we have more valuation comfort. Mphasis clearly at 23x, FY27, looks reasonably placed. Coforge, if we adjust for growth, it looks cheap. It's a 30% earnings CAGR company over the next 2 years, trading at 30 odd times. So on a PEG basis, it is one of the cheapest mid-cap stocks. So these are the 2 stocks which are above in our pecking order. But overall, I think the mid-caps will continue to outperform large caps as far as the growth is concerned.
Coforge, I mean, I'm just sorry to press on this, but there was some news a couple of weeks back about one of their large clients. I think it was Sabre, if I'm not mistaken, where there were some growth concerns coming in. The company said there's nothing material to disclose. Any concerns on the horizon? I'm just asking because the stock has run up so much. So what should investors watch out for, if any red flags?
Yeah, in fact, the stock has corrected sharply after their Q1 results, and now the valuations are reasonable on a PEG basis. As far as the Sabre is concerned, there was a guidance cut. Obviously, the stock reaction was very sharp, but Sabre has gone through, worse times, right? It was almost filing for bankruptcy. They have sold, hospitality business and, reduced their debt. So financially, it's in a much better position. A guidance cut here and there, I think, may not impact vendors because we have to also keep in mind that the deal that Coforge had with Sabre was a cost takeout deal. So in a way, it's part of the process for them to, lighten their balance sheet and improve their margins. Till now, we have not heard any impact of that on Coforge, on that deal ramping up.
Okay. All right. We'll leave it on that note. Abhishek, thanks very much for joining in. Good to get that perspective on a bunch of IT stocks. So mid-cap IT, still his preferred pick over large